Welcome to the Deep Dive, where we pull out the most critical insights from all the latest daily economic, corporate, global reports. And today, we're taking a look at something really fascinating, almost contradictory, about the state of the economy. We're going to cover everything from, personal household budgets all the way up to the massive market swings we're seeing from AI tech.
It's an essential deep dive, really, because if you zoom in, you see these two forces that just feel like they're pulling in opposite directions.
Exactly.
On one hand, you have this incredible success story. Personal wealth, especially retirement accounts, they're hitting fresh record highs. But on the other side of that coin, the next generation is facing these grinding structural pressures. Housing affordability is just crushing, and our industrial supply chains are getting hammered.
Absolutely. We're sort of like forensic economic investigators today, trying to trace these threads from a rising 401k balance to, literal corporate espionage and even geopolitical fights over minerals. Our mission is to unpack that paradox. So let's start with maybe the most fundamental thing, where people live, and the enormous cost of just launching an adult life.
We have to talk about the struggle to launch. It's a big deal right now. We're seeing a really significant reversal of the post-pandemic trend.
I saw that. For a little while, it looked like young adults were finally moving out on their own.
They were, but that trend is now reversing, and sharply.
The numbers are pretty startling. The latest data shows 32.5% of adults aged 18 to 34 are now living with their parents.
Which is up almost a full percentage point from just last year. It's the first time that number has gone up since the peak in 2020.
And this isn't just a random fluctuation, right?
Oh, not at all. Statistical analysis confirms a clear, direct correlation here. This increase is being driven almost entirely by one thing: housing affordability. The link between insane rental prices and young adults moving home is, well, it's undeniable, especially when you look at it region by region.
The geography of it really tells the story. It feels less like a single national trend and more like a series of regional crises.
Totally.
You look at New Jersey, it leads the nation with 44% of this age group living at home. Connecticut is right behind at 41%.
And then you contrast that with a place like North Dakota.
Right. Just 12% in North Dakota. D.C. is barely over that at 13%. That huge gap shows you that it's the high-cost coastal areas that are really pushing this cohort to the brink.
And a quick technical note on that data, which I think is important. The American Community Survey, the ACS, it lumps 18 to 24-year-olds in with the 25 to 34-year-olds.
So they can't really separate them out.
We can't yet. And that's a key detail. We don't know if this reversal is driven by, say, new college grads boomeranging home, or if it's the older group, the 25 to 34s who have jobs who just can't make rent. That's a nuance we really need to figure out.
Okay, so speaking of housing,
Yeah.
for those who are trying to buy, despite all these affordability problems, the market for existing homes actually saw a little surge in October. It hit an 8-month high. What happened there?
It was really just a temporary break in borrowing costs.
The mortgage rates.
Exactly. The Fed started cutting rates again back in September, and that pushed the average 30-year fix down to, 6.17% by late October?
The lowest in over a year, right?
Lowest in over a year. And that small dip, it was just enough to pull some of those sideline buyers back into the game.
It just shows how sensitive the market is because the fundamental problem hasn't changed at all.
Not one bit. The median existing home price is still sitting at $415,200, and that makes it the 28th consecutive month of annual price gains.
28 months. And inventory is still painfully low.
A 4.4-month supply. So even if your mortgage payment softens a little, that high principal is just a persistent wall for a lot of people.
It absolutely is. And this brings up a fascinating point you found about what actually determines a property's value.
Right. Everyone knows a home in a big city is valued higher, maybe 60% higher than a non-metro home. But the research on just neighborhood quality, that carries a massive price risk people overlook.
This is where it gets wild. We're not just talking about good schools. We're talking about tangible negative conditions.
Exactly. Having abandoned or vandalized buildings nearby can slash a home's value by a shocking 17%.
17%.
Yeah.
Just from a nearby eyesore.
And even something as simple as visible trash in the area can knock the value down by 8%. We talk about the ROI on a kitchen remodel, but maybe fixing local blight is one of the highest ROIs you can get.
No kidding. So let's pivot from that real estate scarcity to the other side of the story of retirement accounts, which are telling a story of incredible wealth accumulation. Here the news is very buoyant.
Incredibly so. We're seeing record highs pretty much across the board.
For personal savings.
Correct. Average retirement account balances hit fresh all-time highs in the third quarter of 2025. And this was all driven by a booming stock market. The S&P 500 was up 14%, and the Nasdaq was up 17% for the year through September.
So what are the average balances looking like now?
The average 401k jumped 9% year over year to $144,400. And the average IRA balance was up 7% to about $137,902.
That's solid growth.
It is. And what's really encouraging is the trend we're seeing among younger savers. They're getting more and more interested in Roth 401ks and IRAs.
Because of the tax advantage down the line.
Precisely. They get it. Pay the taxes now, and all your withdrawals in retirement are tax-free. It's a huge benefit, especially if you think you'll be in a higher tax bracket later in life.
And for anyone listening who's tracking their own progress, these numbers are a good reminder of those key goalposts.
Yes. Remember the milestones. You're aiming for 1x your salary saved by age 30, 3x by 40, 6x by 50, and the big one is 10x your final salary by age 67. That 10x target is what gives you the highest chance of maintaining your lifestyle.
And this market is certainly helping people get there.
It is.
Moving into the corporate world, that split we just talked about, affordability versus wealth, is playing out so clearly in retail right now. It is all about value.
It really is. That macro pressure is showing up everywhere. The big winners, value and necessity retailers.
Like Walmart and TJ Maxx.
Exactly. Walmart and TJX both raised their full-year forecasts. And what's interesting with Walmart is their e-commerce growth, up 25% in the U.S., and they're pulling in customers from all income levels, not just people who are struggling, but wealthier shoppers, too.
Everyone wants a deal.
Everyone wants a deal.
Then you've got the mixed results, like Gap. Overall sales were up 5%, mostly driven by the main Gap brand after a viral denim campaign.
That milkshake campaign, yeah.
But their other brand, Athleta, was what they called an eyesore. Sales were down 11%. It just shows how hard it is to compete if you aren't offering either pure value or a clear necessity.
And that difficulty is really hammering the specialty players. Look at Bath & Body Works. They reported, and I'm quoting here, disappointing Q3 results, slashed their outlook, and the stock plunged 25% today.
Wow.
Yeah. The CEO immediately announced this drastic turnaround plan. They're going back to core products, body care, fragrances, and cutting entire categories like hair care and men's grooming. It's a huge pivot.
And trying to save a lot of money in the process.
A lot. They're targeting $250 million in cost savings by 2027.
Okay, shifting from product strategy to industrial trauma. The supply chain for the F-150 is literally under fire. Again.
This is just a catastrophic, ongoing problem for Ford. Another fire ignited just today, November 20th, at the Novelis aluminum plant in Oswego, New York.
And that plant is critical.
It's the crucial sole supplier of specialized aluminum for the F-150, and this new fire comes right after a much bigger one back in September.
Right, the September fire was so bad that Ford had to cut its profit forecast by up to $2 billion. And now another one at the same supplier.
The ripple effect is just immense. Ford had already paused production of the electric F-150 Lightning indefinitely. Gas-powered truck output was disrupted too. Novelis had hoped to be back online by the end of December, but this new incident, it almost certainly delays that. Huge uncertainty for Ford's fourth quarter.
That theme of industrial safety failures continues in the skies too. We just got a critical update on that fatal UPS cargo jet crash from November 4th.
We did. The NTSB's preliminary report found evidence of fatigue cracks in a left pylon support structure.
And the pylon connects the engine to the wing, right? So that's a fundamental part.
It's a foundational structural element. Safety experts are calling it a major clue in the investigation.
Chilling. And there was something about the plane's age and its inspection schedule.
Yes. The plane was 34 years old. But crucially, it hadn't flown enough cycles, enough takeoffs and landings to trigger the special detailed inspections for that specific part.
So the cracks showed up before they were even required to look for it.
Exactly. And because of that, UPS, FedEx, and the FAA have temporarily grounded similar wide-body jets, the MD-11 and the older DC-10s, because of similarities in their design. It's drawing comparisons to that awful 1979 American Airlines crash.
A serious move. Now let's look at the future of flight, where the drama is more competitive than structural. There's corporate espionage brewing in the air taxi world.
There is. Joby Aviation is suing its rival, Archer Aviation. They're alleging that a former policy lead stole confidential files right before leaving to join Archer.
And Joby claims Archer used that information.
They claim Archer used those stolen details to one-up Joby on a big partnership deal with a real estate developer.
Yeah.
I mean, this is classic friction in a high-stakes, cutting-edge industry. Archer, for their part, just calls it baseless litigation.
Okay, let's pivot now to the absolute center of the market's excitement and anxiety. AI chips. Nvidia just dropped a blockbuster earnings report.
Blockbuster is the word. Beat expectations. Strong forecasts. CEO Jensen Huang says demand for their next-gen Blackwell chips is off the charts.
But the market reaction today, November 20th, was completely baffling.
It was an incredible display of volatility. Nvidia initially surged over 5% pre-market. The whole market was up. But then, as the day went on, it just completely reversed, closed down 3%.
And it dragged the whole market with it. The Dow down nearly 400 points, NASDAQ down over 2%.
A massive intraday swing.
So if the CEO says demand is off the charts, why did the market panic? Does the valuation just not matter when the growth story is that strong?
That is the trillion-dollar question. And it defines this whole bubble debate. Jensen Huang, of course, says there's no AI bubble. But then you have someone like Ray Dalio on CNBC saying, quote, "We are definitely in a bubble."
So the market is just grappling with that tension.
It is. It's grappling with the fact that even if demand is certain, the valuations are based on earnings that might be decades away.
And Dalio's advice was interesting. He didn't say to just sell everything.
No, he was more nuanced. He said, don't sell just because there's a bubble, because these things can run way longer than you think. His warning was just to expect very low returns over the long run, even if the party keeps going for a bit.
And this whole debate is playing out against a very tense geopolitical backdrop, where these chips are now seen as a national security issue.
That was really underlined by a federal indictment that was unsealed today. 4 men were charged with a plot to illegally export millions of dollars worth of restricted Nvidia chips to China and Hong Kong.
Specifically the A100, H100, and H200 models.
The most powerful ones. They were allegedly routing them through places like Malaysia and Thailand to get around U.S. export controls.
Why are those specific chips so heavily restricted?
Because they're critical for military and supercomputing. These are the chips you need to train the biggest, most sophisticated AI models. They're essential to China's military modernization for things like advanced weapons systems and testing. The global chip supply chain is now a strategic military asset, period.
And sticking with regulation, there's also news on the domestic front, with a push for a single federal AI standard.
Yes, the AI industry really wants a single federal standard instead of, 50 different state laws. That would be a regulatory nightmare for them. And a draft executive order from the Trump administration is aimed at making that happen.
How would it work?
It proposes creating an AI litigation task force to legally challenge state-level regulations.
And they plan to use some pretty big political leverage to enforce it.
Massive. The order reportedly threatens to withhold federal funds, specifically from programs like BEAD, the big broadband deployment program, from any state that passes AI laws a task force doesn't like.
That is a powerful policy weapon.
It really is. It's designed to force states to fall in line on AI regulation.
So moving from digital assets to physical ones, there's a huge global scramble happening at the top of the world for critical materials.
The race for the Arctic's critical minerals is heating up dramatically. As the ice melts, Greenland is becoming newly accessible, and it's a major untapped source of rare earths and other metals like germanium and gallium.
And explain why germanium and gallium are so strategic. They're not exactly household names.
No, but they are essential building blocks for semiconductors, for EVs, for military guidance systems. And here's the critical part. China is the primary global producer, and they have already banned exports of these two metals to the U.S. once before.
Proving they're willing to use them as a weapon.
Absolutely. So now you see the U.S., Canada, and Russia all jostling for influence over these future resources in the Arctic.
This all connects back to the macro picture we started with. The latest jobs data just came out today, stronger than expected.
Yeah, 119,000 jobs added in September. And what's fascinating is how that immediately changes the calculus for the Fed. That strong number dampened any hope for a December rate cut. The probability is now down around 40%.
Because a resilient job market means sustained inflation pressure.
Exactly. So there's less incentive for the Fed to ease up. And that instantly hit risk assets.
Right. Bitcoin fell to its lowest level since April, about $86,000. Investors are just pulling back from anything volatile. Gold also dipped, interestingly. even though analysts are raising their 2026 price target for it to $4,500 an ounce.
Citing all this geopolitical risk and central bank buying as a long-term tailwind.
And finally, on geopolitics, we saw movement in the energy markets.
We did. Oil prices fell as the market started to assess a new U.S. push for a peace proposal between Russia and Ukraine. The proposal reportedly includes territorial concessions, which raises the big question of whether sanctions on Russian oil companies like Rosneft and Lukoil might be lifted or delayed.
So after all that, what does this all mean? We have covered a ton of ground here. We've connected young adults struggling with housing to the gains in the retirement funds. We've traced supply chain fires to American trucks and tracked the wild volatility in AI stocks all the way to a geopolitical race in the Arctic.
I think the final takeaway for you is that persistent contrast we started with. Structural wealth versus structural affordability constraints. Even with these record highs in 401ks, those key life decisions like where you live, your personal stability, they're still being dictated by these punishing regional costs and by a central bank that's reacting to a job market that just will not quit.
A truly necessary synthesis of what's driving decisions at every level. Okay, now for the provocative thought to leave you with. Experts project that the actual commercial reality of this Arctic mineral rush, the sheer logistical challenge of mining in that environment, will take 15 to 20 years to yield any serious profit. So given that long timeline, how long can the economic and military competition between global powers keep escalating before the true frozen logistical reality of Arctic mining finally sets in and cools down all the rhetoric?
Something to think about as the political temperature keeps rising over melting ice.
That's it for this deep dive. We'll see you next time.